In this video, I'm going to talk about the no stop loss swing trading Forex strategy. Stay tuned. Hey traders, a very warm welcome to you. Okay, this is a different one. I found this one online. I want to share it with you. Let's talk about this and see if it's any good. Okay, this is a no stop loss swing trader strategy. So, man, disclaimers, usual stuff. Be very careful with this. I think this has got some real hidden dangers to it. But anyway, let's get down to the rules of it and let's see what's going on. So, the theory of this trade strategy is, let me bring the chart in a little bit for you. We have two exponential moving averages. One is an 18, and that happens to be my yellow one this time, and my red one is a 9. Both exponential moving averages happen to be on a daily chart at the moment with the euro US dollar. I would suggest you could probably get away with this on any currency pair that's reasonably liquid and any time frame above probably a 4 hour, I would say. But anyway, let's get down to it. So the theory of this is it's a standard moving average crossover strategy. So you're buying when the moving average crosses the 9 period crosses above the 18 period. I forgot which ones we're using for a second then, and you sell and you go short when the 9 crosses down below the 18 period. Now, one warning for this, and there's multiple warnings with no stop loss strategy, is the risk is open-ended. You've got to be trading it small, not recommended at all. If you're not capping the risk, you kind of lose control over stuff. But there's something to be said about trading without a stop loss, and I've done a couple of videos before about the idea of not using a stop loss and managing your risk with size and with being aware. So it's not something to be completely dismissed. You can still manage risk effectively, with kind of reviewing it. But I'm just putting out there and saying, hey, if you're very, very new to it, you should always use a stop loss. Anyway, let's get back down to the rules. So the rules are, as the moving average crosses to the upside, so for example here we've got in euro US dollar, the fast moving average crosses up, so you go long, so you don't use a stop. The idea is that you only use a stop after the first counter trend move. What do I mean by that? So in other words, as the price goes in your direction, the first pullback, the low of that's when you drag your stop up. You don't use a stop initially. The reason that the inventor or whoever it is says that this is the way that he likes to do it is it avoids you getting whipped out in the beginning only to see it going in your way. Now, there's a pros and cons to that. Stop losses are there to protect your capital, to protect you getting hurt if you're wrong. However, there is something to be said that noise can ping you out unexpectedly, so it's worth investigating, right? In this instance, you're good. I'm guessing the first counter trend move is here, so you drag your stop to here. The next one comes up, it's here. You drag it to here. You're probably just about in. Your stop still here. Pushes up again. You drag your stop to here as the low. Pushes up again. Pulls down. Do you drag it here or do you drag it here? If you dragged it there, you're probably out on here. Regardless, that's a pretty good move, isn't it? Although I'm saying that, I've said that, but I've just noticed we've crossed over down here. So in actual fact, if you're following the rules strictly, my guess is you're probably going to be out as you cross back over. You've got to, because that's just the rules of the game. So you're probably going to be out here. But still, we're talking a pretty hefty move here. Let's have a look at something else if we were looking at a short side. So here, as the fast moving average crosses over, you're going short, no stop. This is working out fine. You're probably going to have your stop loss here, and it's a little bit of a scout trade. I want to find one where we don't get stopped, but we take a lot of heat initially, because that's going to be the true test to this kind of thing, isn't it? It's a case of, it's all very well, but if you're getting caught out, and so you've really got to watch out, guys, that you don't. Let's assume we take this one. You've got to watch out you don't take this over any news or anything like that, because you could get completely annihilated. But let's assume, forget that we've got this little spike here. Let's assume we take this long crossover here, which is part of the rule. So we'd be long here. Now, what he does say about stops is he says, let's forget that we've got this spike up here that we could have taken profits on. Let's assume that we've got these kind of closes down here. It's gone against you straight away. when you come out of the trade, is the obvious thing that immediately springs to my mind and probably your mind is, when the heck do you come out of the trade if you're wrong immediately? Because it's going to happen, right? You're going to go long, you're going to be long here, and the thing's just going to tank on you. What do? Well, the guidance is, if you get multiple closes against you under the moving average, so against that slower moving average, what were we again? The moving average 18 was our slower moving average. So if you get multiple closes below that, then you come out of the trade and you reassess. Now, this is the kind of thing that I know is profitable for some people, but of course your risk is open-ended. You don't know where it could go, and this is probably a great example. And you've got to be very disciplined. You say to yourself, well, where am I going to come out of it? What's the deal? And unfortunately, if it goes against you, do you give it 2? Do you give it 3? You can have 2 monster range days and lose a dramatic amount, and then you could maybe just have 1 or 2 days and you lose a small amount. So obviously that's going to skew your performance. However, I get the concept of this. Is something that I think can be expanded on. I'm always interested to hear what you guys have got to say about this. The no stop loss method, or maybe a very, very wide stop loss, assuming that noise is the problem. Now, I always think you can refine your entry a bit better to eliminate the fact that you don't need a stop loss. And obviously, something that you've got to be aware of here, guys, if you're trading it in chop, you're going to get pinged and pinged and pinged. Now, the point, I guess, is if you're not using a stop loss and you're going short somewhere like this, and it goes against you, you can afford to hold on to it and wait to come out at break even or small loss. And actually the noise won't affect you, because you're not going to be coming out when it just goes against you. You're going to be able to hold it as it comes back for you. So as crazy as it sounds, it may be something to consider. Obviously the open-ended risk is potentially deadly. If you have a catastrophic move against you 3 or 4 days in a row, you could wipe yourself out. So it's something to be aware of. But we're all big boys here and girls. If we understand the risk, there's all risk in all types of trading. If we understand the risk and accept the risk, then maybe it's something to be developed. Anyway, guys, that's the no stop loss trade, swing trade. Let me know your thoughts on that. I'll be interested to hear what you guys have got to say about this one. Take care, good trading. See you in the next one. Bye bye.